Good morning and welcome to the Jacobs Levy Equity Management Center for Quantitative Financial Research Conference. I'm Chris Gatesy, and it's my pleasure both to be the academic director for the Jacobs Levy Center and also to host today's event. It is the mission of the Jacobs Levy Center to integrate the many disciplines contributing to the field of quantitative finance, including accounting, statistics, finance, and operations and information management. Today's presenters have made strong contributions to this field through their research, and we look forward to learning not only from them, but from each of you throughout our conversations and interactions today.
I'd like to welcome everyone to the second annual conference of the Jacobs Levy Equity Management Center for Quantitative Financial Research. We established the Jacobs Levy Center and the Wharton Jacobs Levy Prize for Quantitative Financial Innovation in 2011 in honor of our firm's 25th anniversary. Christopher Herdlicka looks at the time dimension of some smart beta factors. Jeremiah Green demonstrates the significance of numerous return predictor signals, many more than the few exploited by smart beta strategies. In addition, Rabi Moussaoui examines how the explosion in ETFs has affected stock return volatility. And Ozzy Ben Raphael asks whether investment managers give clients a fair shake when it comes to trade allocation.
So management companies have diversified sets of clients. They manage defined benefit and defined contribution plans, endowments, insurance companies, mutual funds, and high net worth individuals. So it's possible that investment decisions that maximize the value of the company as a whole may differ from those that maximize the values of individual clients. But the question is, do management companies display favoritism towards some of their clients or products at the expense of others?
In the paper, we try to shed the light on how ETFs increase the volatility of the stocks in their basket by increasing the exposure of those stocks to high turnover or high frequency investors, and thus amplifying the propagation of liquidity shocks to those stocks. In highlighting this phenomenon, we try to emphasize or stress on the importance of arbitrage as the channel through which these shocks are propagated.
We are delighted to welcome as our keynote speaker, Jeremy Siegel. He is the Russell E. Palmer Professor of Finance at the Wharton School. He has served as a research fellow at the Federal Reserve Bank of Philadelphia, academic director of the Securities Industry Institute, and senior investment strategy advisor for Wisdom Tree Investments, among many other prestigious posts.
The one word most frequently applied to Professor Siegel and his work is best. His book, Stocks for the Long Run, was deemed one of the best business books of all times by both the Washington Post and Businessweek. His articles, The Equity Risk Premium, Stock and Bond Returns Since 1802, and the article, The Shrinking Equity Risk Premium, both received Best Article Awards from the Financial Analyst Journal and the Journal of Portfolio Management. I suspect Professor Siegel is most proud, however, of his Best Teacher Awards. We are delighted that he is here with us today to educate us all. Please join us in welcoming Professor Jeremy Siegel.
I'm often asked, Jeremy, you've had a lot of students in all your years, 38th year at Wharton, 4 years at University of Chicago. I estimate about 10,000 students. And they say, well, there must be some famous ones among that group. And Bruce and Ken, they are definitely the two that I mentioned. Very, very proud to have had them in my PhD class one of the first years actually that I was here at Wharton. All right, what I'd like to talk about is valuation of the market, and valuation of the market as seen by Bob Shiller in his very well-known work on what is called the CAPE ratio. So in summary, is the market 51% overvalued? No, not at all. And in fact, by Bob's changes in his own methodology of looking at it, plus looking at the evidence of what changes have happened in the accounting of S&P over that period, you could argue that the market is either very slightly overvalued or not at all, according to the CAPE methodology. I'm ready for questions.
I'm going to characterize some of what's happened over the past couple of decades. You may not agree with all of my characterization of the past, but I think it will provide an interesting way to discuss what we're doing here. So in this earlier paper, we sort of went back and looked through all of the academic literature on things that researchers had claimed predict stock market returns. And we're talking about equity returns primarily in the US, and we're also talking about firm characteristics. We're not doing any macro type predictors. And so we looked through, and if you just, this is a count, the cumulative count of the things that academics have said predict returns. So we're not the first to do this. Let's take a step back. So 25 years ago, or around, 26 years ago, some people called Jacobs and Levy, they did something, right? And you see here it says, so you could pretend that these lines are actually our paper, but it's from theirs. It says, most previous stock market anomaly research has focused on 1 or 2 return regularities at a time. Interestingly, that hasn't changed much since then. Right? Most papers, even in 2010, were doing the same thing that they were discussing here. And they said, well, we're going to go and look and see, are these independent signals, and what happens when you measure them together? Well, because people sort of ignored that, we're going to do the same exercise, but moving out here. Right? So then a little bit after them, Fama and French do something similar.
The key idea is returns occur when risk is resolved. Now, this idea in and of itself isn't new, but what we're going to do is take this to financial markets and the study of the factor structure of asset returns. Okay. So, keeping with this analogy, right, financial markets operate very similar to the casinos, right, except we have positive expected returns, right, much better deal. And kind of what does this mean bigger picture? Okay. So bigger picture means we have to consider the information structure and risk jointly in determining our factor structure.